Hey there, savvy investors. Welcome back to the Dividend Uncle channel, where we delve into the intricacies of the investment world to empower your financial journey. Today, we're embarking on an insightful exploration that might just redefine your investment strategy. In this episode, we're turning our gaze towards Europe, a region that's hinting at a financial shift potentially beneficial to investors eyeing Europe-focused REITs. Yes, you heard that right. With inflation trends diverging between Europe and the US, we may see European interest rates taking a downward turn sooner than expected. This development holds significant implications for REITs operating in Europe, especially those that have been lagging in performance recently. Before we dive deeper, remember to hit the like button, subscribe, and ring that notification bell to stay updated with the latest insights from the Dividend Uncle. Your support enables us to bring you more of these in-depth analyses. Now, let's unravel the potential opportunities lying in the European REIT sector. Understanding the interest rate context. Inflation dynamics are pivotal to central banks' interest rate decisions, influencing everything from consumer spending to investment returns. Recently, we've observed a notable divergence between Europe and the US. Eurozone inflation dropped to 2.4% in March, moving closer to the ECB's target of 2%. This is the fourth consecutive month of decline, signaling a stronger disinflation momentum in Europe. On the other side of the pond, the US sees a different story, with inflation rates inching upwards, suggesting that the Federal Reserve might not ease monetary policy as soon as some might hope. What does this mean for investors? The possibility of the ECB cutting rates sooner can lower borrowing costs and stimulate economic activity in Europe, potentially benefiting real estate investments. However, it's crucial to keep an eye on the Federal Reserve's moves. If the Fed does not cut interest rates as anticipated, it could spell bad news for the other REITs, but that's a story for another day. For now, our focus remains on the promising outlook for European REITs in light of the potential for earlier interest rate cuts in Europe. Spotlight on European REITs, navigating through change. Now, let's examine two Europe-focused REITs poised to gain from the anticipated rate cuts. Interestingly, the price of one has already begun to climb over the past week. Cromwell European REIT stands as a testament to strategic management and portfolio resilience. With a robust portfolio valued at €2.3 billion, its focus is split, with 53% dedicated to the burgeoning light industrial and logistics sector, covering 110 predominantly freehold properties. Despite the upheavals brought on by the pandemic, Cromwell European REIT boasts a 6-year track record of stable DPU payouts, a testament to its operational resilience and strategic foresight. In FY 2023, the REIT saw a marginal DPU decline of 4.1% on a like-for-like basis, an impressive feat considering the 32.8% spike in finance costs. Portfolio valuation dipped just 1.5%, underscoring the efficacy of the management's divestment strategy aimed at optimizing the gearing ratio and transitioning towards sectors with more stable demand. With a dividend yield hovering around the 11% mark, Cromwell European REIT's blend of portfolio durability and proactive management makes it an enticing prospect for investors eyeing the European market, especially in light of the potential ECB rate cuts. Astute investors have already taken note, pushing Cromwell European REIT's unit price up 5.76% over the last 5 trading days. iREIT Global, navigating challenges with strategic acquisitions. iREIT Global's €0.9 billion portfolio spans 54 properties, with a significant 77% allocation to the office sector and the remaining 23% in retail. Backed by strong sponsors in City Developments Limited and Tikehau Capital, iREIT Global has faced its set of challenges. FY 2023 was particularly tough, with DPU tumbling by 30.5% due to an expanded unit offering and rent-free periods extended to new tenants, reflecting the competitive pressures within the real estate market. Yet, it's not all bleak for iREIT Global. A recent acquisition of B&M retail properties marks a pivotal shift, potentially rejuvenating its portfolio. Coupled with an attractive dividend yield of 7.8%, iREIT Global stands at a juncture where forthcoming interest rate reductions could significantly enhance investor sentiment and operational performance. The anticipation of easing monetary policy in Europe could offer a much-needed lift, particularly for iREIT with substantial exposure to office and retail sectors poised for recovery. The Dividend Uncle's take, a long-term perspective. In the realm of investment, especially when it comes to REITs focused on European assets, a long-term perspective is paramount. The potential for interest rate cuts in Europe presents an intriguing opportunity, particularly for underperforming REITs like Cromwell European REIT and iREIT Global. These entities not only offer attractive dividend yields but also stand to benefit significantly from an easing monetary policy environment. However, as long-term investors, our focus should extend beyond immediate financial metrics and interest rate movements. The true value and resilience of an investment lie in the consistent performance of its property portfolio and the strategic acumen of its management team. For Cromwell European REIT, the portfolio's resilience, strategic divestments, and shift towards sectors with stable demand underscore a management team that's adept at navigating through market fluctuations while maintaining a strong focus on shareholder returns. Conversely, iREIT Global's recent challenges highlight the importance of proactive management in steering the portfolio through uncertain times, signifying potential for recovery and growth in a supportive interest rate environment. In addition, while the anticipated interest rate cuts in Europe compared to the US present a favorable backdrop, it's crucial for investors to delve deeper. The lower inflation in Europe hints at poorer economic performance, and the outlook may affect the demand dynamics of the REIT's underlying properties and their tenants. As we move forward, let's remain vigilant, assessing both the performance of the property portfolio and the evolving economic landscape in Europe. In conclusion, the evolving interest rate scenario in Europe, contrasted with the US, opens new avenues for investors, particularly in the realm of European-focused REITs. With proper analysis and strategic planning, this could be an opportune moment to diversify or adjust your portfolio to include assets that stand to benefit from Europe's monetary policy shifts. As always, the Dividend Uncle will continue to monitor these developments, offering insights and updates to help you navigate the complexities of the market. Thank you for tuning in to today's insightful discussion. If you found this analysis helpful, please like, subscribe, and share your thoughts in the comments below. Until next time, keep investing smartly and stay tuned for more updates from the Dividend Uncle.